Hey guys, it's Crossroads here. Today we're going to talk about the market as a whole, really looking at the question of why I'm not buying the dip. I had a video back in August with the in carry trade about when to buy the dip. This is one that I've held off of. I made a video also last month where I said, I didn't think that the dip was over. I didn't think that the bull market was over. And I may be wrong on that one, guys, honestly. My goodness, I'm shocked with the implementation of tariffs, which is, of course, causing a lot of pressure on the market. I thought maybe we'd get tariffs kind of like we had under the first Trump administration, which didn't shock. It scared the market a little bit. It always will, but it didn't absolutely implode the markets. Instead, what was revealed in Liberation Day was a plan to try to even out trade deficits. It wasn't even about unfair practices or anything like that. And the market did not take that well, continues to not take it well. And the hard thing is, this is a dip that may continue to dip for quite some time until we get some certainty. I've also made mention of that too, that the markets hate uncertainty. And right now, we've got a lot of it. We've got a whole lot of fear in the market. Take a look at this. This is CNN's Fear and Greed Index. It's not my favorite indicator, to tell like where things are going, but it kind of shows where we're at in all of this. So having a 5 on extreme fear is about as extreme as it goes. It did get down to 4 briefly. It may finish lower. It can't go below 0. So that's the good news, I guess. This is COVID level of fear right now in the market. I'm laughing just because it's so ridiculous. Here's the timeline, by the way. You can see there's been a lot of moments of greed and extreme greed in the market. It's quite low. There it was. You saw the 4 briefly. There's a lot of things that contribute to this, but you can see where we've moved. That a week ago we were at 21, which is extreme fear, but not at this point, not capitulation stage, which is frankly where we're at. That usually means that the dip is going to be over sooner than expected. A month ago we were at 11. A year ago we were neutral, of course. And yeah, this thing is just plummeting off a cliff. S&P 500 as well. So usually when you hit extreme fear of this level, there it is. It's 4 again. What happens is it's a great time to buy quality companies for the long term. I'm not. I'm waiting for a little bit more certainty and clarity on tariffs. I don't mind paying a higher price, but we'll talk about some historical ramifications. Now, let's look at the VIX. This is the volatility index, CBOE's tool, which they have on their chart. This is showing just kind of over the last year. You can see that there's been spikes even higher than this. This one right here in particular, I made a video on it on that day. And overnight, I believe it was in the 60s or 70s. I'm like, okay, this is silly. It's an absolute great time to buy the dip. And it turned out to be the case. Here, of course, I was buying the dip and we talked about that as well. And here, not so much. I feel like this is a lot more justified. Now, to get an idea of like historically where we're at, right now we're just under 40. VIX, by the way, doesn't remain elevated for long. You can see that here, that 20, if it goes over 20, usually it's short-lived, just because the nature of the way the markets are moving. They can only move down so far, so fast. Of course, there's more to the VIX than just the downward pressure, but that's certainly the biggest contributor, especially the speed of this drop. But you can see here, just like, it's hard to even like see how fast this came. And VIX can absolutely do that. Now, we're not nearly as high as COVID, but outside of COVID, outside of like just a little blip on the radar or overnight price action, this is the highest it's been since COVID. Other events, recession fears. This, of course, is a great financial crisis. Going back further, the VIX actually didn't exist at this time. It's just implied what the VIX would be. But it's certainly elevated. It won't be elevated forever. It could be for a week or two at this. And let's look lastly at the index. So, of course, with the NASDAQ, which I don't even want to look at, if it finishes where it's at right now at the time of this recording, or at least a few minutes ago, we will technically be in a bear market on the NASDAQ. That's a 20% correction from the top. S&P 500 has a little bit further to fall, and that's really the better indicator to see whether or not we're in a bear market or not, technically or otherwise. But you can see from the peak, we're down actually about 15% or so. Once we hit 20% and we close, that's when it's considered a bear market. Now, what bigger indicator here is, and I've talked about this before in the buying the dip opportunity, the RSI, the relative strength indicator. This is basically showing once it goes below 30, it's considered oversold. Above 70 is overbought. In a bull market, things can be overbought for a while. You can see that back here. In a bear market, things can be oversold for a while. We're not in a bear market. And actually, RSI right now is at 25. It's very low for a bull market. Now, let's zoom out a little bit more. If we look over the last 5 years, you can see little times where it did go under. Here in 2022, at the start of that, near the start of that bear market, rather, we saw that it remained under for actually a couple of weeks. That can definitely happen, especially in a bear market. So this is, I think, indicating that we're likely to bounce at some point. We may have already hit the local bottom. So why am I not buying? We got extreme fear. We have quality names left and right that have fallen to ridiculous levels. For instance, I never thought that we'd see PayPal again in the 50s. Here we are. We can go lower. I'm seeing Nvidia, under $100. I'm seeing a lot of the Mag 7 looking very attractive at these prices that we have not seen in a long, long time. So the issue really is history and where I see us being at. So there was in the 1930s, actually in 1930, an act called the Smoot-Hawley tariffs. Now, the conditions for this, basically the Depression, which was not the Great Depression, it was really a recession at that point, although it looked fairly severe. It started in 1929. But even in 1928, people knew, it's just one of those cycle things, that a recession was coming, and were taking steps accordingly. Now, what happened in 1929, of course, is that Black Monday, everything just fell apart in the stock market. We entered a full-blown recession. And in 1930, the Republicans that were in the Senate thought that it might be advisable to protect U.S. manufacturing by passing a series of tariffs called the Smoot-Hawley tariffs. Now, initial discussions were on fairly moderate tariffs that probably would have had a pretty large basis of support. Instead, those that were a little bit more extreme, Smoot and Hawley namely, they ended up passing very aggressive, very rapid tariffs that ended up spooking the market and causing a whole lot of issues. Herbert Hoover was urged by many, many economists and Democrats as well to veto this bill, but instead he signed it into law. He didn't want to go against his own party. As a result, and I think almost every historian says that this is true, is that this, if it didn't give us the Great Depression, it certainly prolonged it, and it caused a lot of pain throughout the world. The problem is with tariffs is when retaliation hits. And we have seen the beginnings of retaliation. That's one of the reasons why the market is selling off again today, is that news out of China. But this can continue to spiral out of control. The era at the time, they used the phrase beggar thy neighbor, that basically you were trying to enrich your country at the expense of other countries as well. And so then they would raise tariffs as well. And it ended up being very destructive for global trade, global relations, and of course the US markets, as well as our entire economy. It caused a lot of issues. Now you can say this time is different. The United States is a world superpower. At the time we weren't, although we were a major player, bigger than most people realize in 1930, especially as far as manufacturing and agriculture. But that's a fair comparison. The United States, of course, has seen a lot of success over the last 100 years. One of those, of course, is that a lot of the economy of the globe functions on the US dollar. And we have a lot of very close ties with close nations. Now, the issue, one other difference too, of course, is technology and the speed of communication, where it would take weeks and sometimes even months for retaliation as far as within this trade war. Now it's going to be a lot quicker. That doesn't mean that it's going to be less painful, though. If this is Smoot-Hawley 2.0, what we're going to see is second and third order effects. So we're already beginning to see some of those second order effects of the retaliation rather than negotiation. We did see some negotiation as well from smaller trading partners. But the reality is that these retaliatory measures can keep getting tit for tat, getting out of control. It's that whole idea where eye for an eye, tooth for a tooth, and the whole world goes blind. We may be in that phase when it comes to the global markets. We don't know. Markets, again, do not like uncertainty. I don't like uncertainty. And so what I did yesterday, rather than buy the dip, I sold into the dip. Rarely do I do this, but when I was looking and seeing at the ramifications of the so-called Liberation Day, I saw a whole lot of Smoot-Hawley tariff action, and as a result, a fairly decent probability of a global trade war causing a recession in the United States, other economies in the globe, and a lot of breakdown in global trade. Now, that may not play out that way. We could, and hopefully we will see a lot of negotiations where people say, hey, let's actually lower tariffs and have free trade across the globe. That would be incredibly bullish for America and also the world. Yet, we just don't know whether that's going to happen or not. Now, another issue too is we don't know what the Federal Reserve will do. Now, I do think that this time the Federal Reserve is not going to make the mistake that they made in the 1930s, where they were very reticent to make any changes at all. Here, Powell even made comments back in March indicating that they would ignore some of that short-term inflation that would be as a result of tariffs, and they would be open to cutting into weakness if needed. And so we have seen rate cut probabilities actually increase. Take a look at this. Now, this is May's Fed Fund meeting on May 7th, and we're now looking at a 38.2% chance of a cut in May. I think it should actually be a little bit higher, and probably the Federal Reserve will feel some pressure to cut. They might not, but they really should at this point. And we can see really it's not shifted much from where it was a month ago. In fact, it's higher probability now than a month ago, which is kind of surprising for no cuts in May. But if we look at the end of the year, we can see that things have certainly shifted towards and favoring more cuts. Now, again, we're at the 4.25 to 4.5. And this is saying that the highest probability, as far as what people's expectations are, is a 3.25 to 3.5. So that's a 1% cut in rates by the end of the year. That's 4 cuts. That was not on the table or anywhere near close to it previously. And we've seen a lot more shifting. You can see how these things have shifted over the last month. I think we may even see a lot more than that, especially keep an eye at this, a 300 to 325. Now, you might say, well, wait a minute, Roy, you're not buying the dip. And this certainly looks favorable for a lot of companies that I hold. And that's true, except in the face of a global trade war and recession. Rate cuts historically, when they're done to save the economy from falling apart, have not been bullish at all. We'll have to see whether or not we actually enter a recession. We'll have to see whether or not we enter a bear market in the S&P 500. But for now, what I did was take off pretty much every single thing that I had that was expiring in 2026. I just did not want to have options in that short a time frame, which it's a year, in some cases more than a year out. Now, I do have some December 2026 contracts on PayPal, which have absolutely been nuked, and I obviously shouldn't have even dabbled in them, but I guess I like losing money in PayPal. So going back to what I did yesterday, I sold pretty much every position that I had that were options that expired in 2026. Did not feel like the right time to be in any kind of leverage that expired within the next year, year and a half. And so as a result, I made some painful moves. Now, some I was still up in. Mostly I was down, some quite painfully down as well. My portfolio, don't even really want to look at it today. So over the next month or so, as you know, if this continues on, there's more and more uncertainty. We'll see a further and further downside in the markets. We could see a bear market. I think at this point, it's not unlikely at all. Recession, I still think is somewhat unlikely, but it's certainly possible. It's not a remote possibility as I once thought it was. It feels like maybe it's a 1 in 3 chance, which is a lot higher than where I was. I thought maybe there was a 3% chance of a recession until 2029. So boy, was I wrong on that one. I could be wrong here again. Lastly, the difficulty of buying a dip like this, where there's a lot of uncertainty, it seems that a lot of the dip is very well justified. Maybe it's even underdone at this point, is what we can go a whole lot lower and see a whole lot more pain. And so if you are buying, I would just recommend being very careful with margin, being very careful with any kind of leverage, being very careful with options that expire anytime soon. You can make a lot of money, but you could also lose a lot of money too. So don't underappreciate the downside. If you are buying, I recommend buying companies that you have a lot of faith and conviction in. Quality companies that are going to be durable throughout recessionary times, throughout a global trade war, that are going to be here to stay. And there's a lot of them on sale at the market. Long term, it's a great thing for long-term investors to be buying, but just be careful what you're buying and why and what money you're using. Anyway, what am I doing from here for the rest of the day? I'm going to take some time off the markets. I'll, of course, be here for SoFi Weekly tonight. But it's a beautiful day in Texas. I'm going to go out and get a bike ride, maybe do some work on my dissertation. Sometimes that's the best thing you can do is just sit on your hands after you've made the decisions you're going to make. Let it play out. Look away from the markets. You don't need to be staring at that screen every day unless you're a day trader. Anyway, let me know what you think in the comments. If you guys are making any moves, shifts, changes, if you disagree with my thesis, love to hear that. I would love to be wrong about this being Smoot-Hawley 2.0. Believe me. Anyway, thank you for watching, commenting, and subscribing. Until next time, happy investing.